the turnover. What is important is the turnover. It is based on your turnover, you will determine your income. You will determine your gross profits and net profits. So therefore, there is no concept of full value of consideration. I compute my profit in profit and loss account with reference to turnover. That's what my institute is telling me. So there is again a foreign concept which has come in the computation of business income, which will have to be understood. All right, you are telling me that it is full value of consideration. We'll discuss about it, I'm sorry, a little later on, just a minute later on. Before that, let me finish this, is that there is a clear-cut case of a double taxation. There is a clear-cut case of a double taxation here is that the undervaluation part is being taxed in the hands of the transfer or builder. Similarly, because of the amendment which is carried out in 2013, reincorporating something which was deleted in 5627, this very difference will be taxed in the hands of the buyer also, isn't it? Under 5627, any purchase for inadequate consideration would be considered as a gift and would be subjected to gift tax, loosely stating. So therefore, here is a case, and giving you an example is, and this is happening on a daily basis presently, please appreciate, that an agreement is executed, for a value of 3 crores of rupees. The stamp duty valuation happens to be 4 crores of rupees. The builder will pay tax on 4 crores if 43CA is implementable, applicable, why should it not be? Then builder will pay tax on 4 crores. Immediately the buyer also would pay tax on 1 crore rupees. Because in his case, the consideration which is agreement consideration 3 crores is not exposed to any taxation. But this is that 1 crore difference is exposed to taxation in the very year in which he is purchasing it. Am I clear on this? Yeah. The saving in a buyer's case would be that he will at least be allowed to substitute it as a cost when he eventually would sell this property, because there an amendment is carried out in 49(4), which is not carried out in this. And here, it's not that it is inflating your cost. So therefore, there is a trouble here, and therefore such provisions, one has to sincerely consider that whether they could be subject matter of challenge or not. The next issue which we are discussing is, and there are plenty of it, I don't know whether we would be discussing all of them or not, because at some point of time the chairman would say that speed it up, and go and fly a kite. Yeah, so we would try to be little faster now. Yeah. Most of the issues surrounding the cutoff positions in 194IA as also in 43CA basically would cover situations, and there are plenty of it. Take a case wherein somewhere in 2000 somebody has paid a money. Somewhere in 2010 the builder has issued, 2002 the builder has issued allotment letter. Over a period you have been making payment. Somewhere in 2010 you have executed an agreement also. And somewhere in 2013, that is today, you are inking the conveyance. So in all such cases, and in between the builder has selectively recognized the revenue in piecemeal or sometimes in full also. Now the issues therefore will galore here, that which is the point of time and what value I should adopt. Something which is already recognized, should I ignore or not? And all such issues arose. I'll just take you to few cases which have been delivered in the context of 50C. And here also you would see that the judiciary is sharply divided, that whether the date of agreement is to be considered or the instrument that is eventually registered, that is the sale deed, that is to be considered. The first one was the Kolkata tribunal case. It was a case wherein the department sought to apply 50C. And here the person said, look here, I have already travelled this journey. You can't put me to this journey once again. His case was that, that my transfer was subjected to the provisions of 37I. I have taken an NOC from the government of India that it doesn't want to purchase as per the provisions of 20C. And the tribunal took a conscious view, a rational view, that once some chapter was applied, you don't apply another chapter to this. And that is what it was. So is the decision of the Visakhapatnam tribunal in the case of Siva Parvati's case. That in such cases the agreement should be honored, though it might have been done even before the provisions even before the time when provisions of section 50C were introduced. But now you have a Calcutta High Court decision, which is a very, very recent decision, which has taken a stand that date of registration is very important, and therefore for the purposes of 50C, it is the value that is prevailing on the date of registration that you have to take. Now look, I am just placing before you the contradictions and the confusions which is going to arise on a massive scale, in the context of this 43CA when it comes to difference between agreements and the transfers, when the transfer takes place. Ideally, one should have considered at the earliest point of time, and all this confusion would have been. The temptation would have been avoided for few years. For the subsequent years, all these issues would not be. In fact, in the earlier days, the government was so forthcoming, was careful, conscious and decent, wherein when TDS provisions were being introduced, it will issue circulars explaining that what are the cut-off dates. If you look into the 1972 circulars, 715, 718, both of 1995, you will see that, specifically the government has explained what is its stand. Here there is a confusion, and this confusion will be fantastic when we come to provisions of 194IA. Issues that are surrounding 50C, and there are many, trust me, those also would be imported in 43CA for the reason that subsection 2 and 3 also have been paramateria introduced in 43CA. So we will skip those things. There is, in the context of 50C, the issue has severally arisen that whether these 50C provisions also apply while applying the provisions of transfer pricing. And this is a decision which has taken a stand. This is a decision of authority for advancement, that even in computing transfer pricing provisions of 50C would apply. And if that is the correct decision, then in that case it would also apply for 43CA also. Yes, somewhere we were talking about now that we would discuss a little later on. Let's, when we have so many trouble, the easiest thing which comes in mind is, can I find out something where under this becomes a non-starter? It becomes something, say, which has no teeth to bite. And therefore the one would see that, that what am I computing? Am I computing business income? The answer is yes, I am computing business income. Is 43CA the charging provision? The answer is no, it is not a charging provision. Is 43CA is deeming an income to be an income which has to be taxed like 44AD or such other provisions? The answer is no, no and no. It even is not something similar to 5627, which is deeming an income to be taxable. This is not a case which leaves the computation of income to chapter 4D, which leaves the computation of income to the institute's guidelines, ICAI revised guidance notes. It leaves it to section 145 and 145A. So therefore I would believe that yes, that it is all the provisions that will have to be of computation of business income that will have to be pressed in service for computing my business income. So alright, you have introduced a provision which has an effect of jacking up my turnover. Assuming for the time being, I am not fully convinced about what I am discussing, but I am throwing it open for the discussion, by these august audiences. But I'll give my reasons also, and they appear to be attractive, at least. Even if they are found to be not valid, they appear to be attractive. That this provision has the effect of inflating my full value of consideration, conceding for the time being that turnover is same as FVC. It has the effect of jacking up my. Being a true citizen and an honest taxpayer, what I am doing is that, I am also recording it in my books of account as an inflated turnover. In the given example, in my books, I record 4 crores as my full value of consideration. And thereafter, I am set about to compute my business income as per profit and loss account. I do not know any other method in which I can determine my profits and gains of business or profession. So I do that. While doing it, one of my colleagues tell me that have you applied all provisions of the Income Tax Act? And my first blush answer is yes, I have applied. So he says that why don't you look into provisions of section 36(1)(7) and 36(2) also. So when I look into that, I realize that there is a provision of bad debt also. A bad debt is a debt which is not recovered. A bad debt is a debt which is not recovered. And in this case also, I have not recovered anything. It is part of my turnover. It's part of my turnover. Computation provisions have to be applied. This is not a fantastic provision which assumed a full value to be the deemed income. It allows me deduction of all expenses. If you consider FVC to be your deemed income, then you will not get deduction even for your labor, even for raw material which you have consumed, and all other peripheral charges and expenses including interest which you have. Now as far as deduction of those expenses are concerned, all of us including revenue department have no claims, no dispute. They say that yes, you are welcome to use these provisions. So why single out bad debt provision? Why single out bad debt provision? That is what it is. You have only told me that this is something I should have received. Now I am telling you that sorry sir, I have not been able to receive it. Yeah, and I am writing it off in my books of account. Will this work? Well, it could appear to be very, very disturbing, unthoughtful, jarring, but you have to give me a legal answer that why would it not work. Yes, right, no? You will have to read the notes to clauses, you will have to read the memorandum explaining the provisions, and perhaps finance minister's speech which he has been silent on this, and then come out with something, or otherwise the best thing is introduce an amendment which you are so have been regularly doing it. That's what it is. But till such time I would believe that it would not be possible. 50C, don't equate it with 50C. You will get many answers in support of 50C, but no answers in support of it. Okay, the negative thing about it is that is a debt created in my favor by virtue of an agreement. That is something, which could be an arguable thing. That a debt, before it becomes a bad debt, it has to be a debt first. Okay, a debt is created when somebody agrees to pay you something. In this case, there is no agreement to pay you something, and there could be a difficulty. Right, permit me to move. There are plenty of things. Okay, good enough. But don't just laugh it off. I think there is a strong case. The very fact that none of you are violently responding, you also believe that But I have been told right from beginning when I started my practices that when you introduce extraneous provisions which are improbable, illogical, be sure that people also will come out with extraneous remedies also. And this could be one of it. This could be one of it. Okay, right. Transactions up to 31st March 2013. There are several possibilities. I'll take you to each one of them before we close this discussion on 43CA. Whether the amendment is prospective or retrospective. On a first reading, it is prospective. It is made effective from 1/4/2013. But would it be retroactive? The answer is yes, it would be. Because it would also apply to transactions which have already taken place, but which are yet to be registered, exposed to stamp duty. So therefore, an amendment which is avowedly prospective would apply retroactively. So therefore, whether that can apply or not, you have several provisions wherein the retrospective or retroactive application Presently 80 IB10 has been the classic case of a retroactive application, and you have conflicting views which have taken stand that it cannot apply to the actions which have already taken place, and the same would also should be here. That would be one of the possibilities. Now we have different possibilities. Let's consider each of them. Is the transfer and income is recognized post amendment, that is on or after 1/4/2013. Now in such case, the provisions what we are examining is applicability of 43CA to this situation. Is that when the amendment has taken place and thereafter the income is being recognized and the transfer also has taken place, then in that case the provisions will surely hit you, and you are advised to apply these provisions. Transfer is post amendment, but income is recognized pre amendment. See, look, there is an allotment which has taken place. On the basis of allotment, I have recognized my income in full. Now in such cases, can 43CA be applied for reopening my assessment? Can it be applied for taxing the difference in the present year, that is in 2013-14? Surely the senior counsel should prevail, and in such circumstances you have to leave this recognition untouched. So all those cases wherein the income has been recognized, I would take a view, and a rational view, I am not being swayed by any taxpayer's benefit, I have never been. So therefore in such cases the issue would be that yes, that when income has been recognized, now please here turn back and read your provisions, read your law properly. What it is saying is accruing. Any income accruing on account of transfer. Income is already accrued and accounted for. What is there which is remaining to be accrued? Nothing is accruing. If nothing is accruing, these provisions will not apply to you. Receipts are before amendment. Receipts are before amendment, but it is not accrued to you because you have not recognized as an income. And there would be a difficulty on account of 43CA. Most of the cases are of this kind, wherein people have received substantial funds, but in their eagerness, in their temptation to defer the taxation, they have not recognized revenue. They have not executed agreements. So in all such cases, there will be a difficulty. A partial income is recognized as something which is difficult to crack. You have recognized a part of income in relation to the same transaction. A transaction of 4 crores, you have recognized income to the tune of 2 crores of rupees. Now what would happen in relation to the remaining? Would you recognize, or you would remaining the entire backlog in the year of transfer? Debatable, very debatable. I will not venture to give you a final answer, but difficult for even revenue also. Partial income to be recognized, that is what we discussed about. Well, with this we proceed. How far we would go? 8 o'clock? 8 is okay, na? I'll try to finish. Yeah. See, all of you, right from our CA final days, all of us are so used to repetition. Now, so we would avoid that. But I'll try to see that, that we cover the important part. And thereafter, if there is a need, we will try to work it out. Okay. Now, yeah. Then this deemed income, the only thing which is to be noted here is the provisions are paramateria. This was the provision which was introduced with effect from 1/10/2009 by the Finance Amendment Act number 2 of 2009, which had been deleted with retrospective effect as if it never took up birth at all by the Finance Act 2010. Now once again, see, this ghost continue to haunt the finance minister. So once again it has come back, and now it is trying to tell us that that whatever is the difference which is happening on purchase of this purchase of the land or building, the difference would be taxed as income from other sources. The scope of it fortunately is limited to individuals and HUF. The scope doesn't travel to take into consideration the other entities. So this is what is the provision. The savior here is that in the event you were to transfer, these very premises, your cost would be the jacked up cost, the inflated cost. Not realizing that when I transfer, I might be asked to pay taxes at a concessional rate. As against that, today I am being exposed to tax which is the highest rate. That also one should appreciate, but be that it may be, this is the provision which is placed before us. There would be issues here also about the cut-off dates. That there have been cases wherein the persons have paid a substantial consideration, agreement is not executed. There have been cases wherein consideration is paid of a minimum amount, but allotment letters are issued. There would be cases wherein agreement is executed, but the consideration is not fully paid. In all such cases, the similar difficulties which arise in the context of 43 CA would also arise and would be visited by the taxpayers in this case also. We now come to TDS on immovable property 1. This is 194 IA, and what are the provisions? Please appreciate. Let's go stepwise instead of summarizing them. These provisions are introduced with effect from 1st June 2013. In this case, buyer who is a purchaser of the land and building has to deduct tax. It's not the seller who has to deduct tax, it's the buyer who is a payer has to deduct tax, assuming that the payment which is making as an income component, because TDS also finally has to be related to some sort of income. So assuming that it is related to income component, it is the buyer who will deduct tax. On what he would deduct? On value of consideration. The stamp duty ghost is not available here, so you don't need to fear it. Okay. Here it is the value of the consideration which is stated in the agreement, which is agreed upon, whether stated in the agreement or otherwise. It is the deduction that would happen with reference to these, and or when it would happen, which is the point of time at which the taxation would arise, the obligation to deduct tax would arise, and that point is at the time when the immovable property, that is land or building or both or part, is transferred, similar to 50C, similar to 43 CA, and similar to 56(2) also. But there is an exclusion in the form of agricultural land. If an agricultural land is transferred, these provisions are not attracted. Or it is a land which is acquired by the government, to which provisions of 194 LA, that is payment of compensation provisions, apply. Those cases are excluded. For some strange reasons, the scope is not restricted to India, but one would believe that it has to be restricted to India only. What is the rate at which you would deduct? 1% you would deduct, or 20% if the seller does not have a permanent account number. I have been sent with several queries. Some have come through chamber, some have directly also. In this discussion, whatever is possible, I am trying to cover each of them. If something remaining, time permitting, we would discuss, or otherwise you can email, and trust me that I will surely reply to that. Surcharge education says, secondary education says, if applicable would be applicable, if not, it would not be. The time would be at the time of payment or the amount of the time of crediting, whichever is earlier, like all other provisions of chapter 17B. And this would be activated only if the consideration for transfer of land or building is 50 lakhs or more. Even 50 lakhs is covered, it's not exceeding 50 lakhs, 50 lakhs also is covered. The status is that if you are a buyer, you don't need to examine your residential status, you need to apply these provisions. Whether you are resident or non-resident, it's not material. What's important is you are buying a property which is, I believe, located in India, and which is land and building, which is being transferred, deduct tax at 1% or 20%. But seller has to be necessarily resident. You need to ask the seller, what is your status? If it is a non-residential status, then different provisions would apply, namely 195 and not 194 IA would apply. As we noted, that this consideration on which tax is to be deducted is surely not the stamp duty valuation. Time for payment is payment or crediting, whichever is earlier, something which we all are very, very familiar. Payment could be by any mode, it will attract deduction of tax. In the earlier provision, the similar provision was sought to be introduced last year and was dropped. This year again it has been introduced. Why do they do this? I don't know. In 1 year you are convinced that this is a good case for not levying penalty. In the next year you are convinced that it is a good case for levying penalty. No rational. It simply shows that how fickle-minded we are. That's all. So 10 is not required, which was required last year. Last year there was a condition that the buyer was required to take a 10, that is tax deduction account number, which is not required. What is funny, I find it funny, may not be funny, is that that a lower deduction is not possible. A lower deduction is not possible. In other cases, you can go to the assessing officer and seek a certificate for a lower deduction, which is not possible here. There was a serious difficulty in the previous avatar. Last year they had provided that registration authorities will not register the transaction, that is the agreement, unless the tax was deducted at source and the proof of deduction was given. Fortunately, this time that is not so, because registration is a precious event in the life of a buyer. If you deny registration, it doesn't acquire right of specific performance, and therefore it was ridiculous for a person, for the government to deny the right of specific performance to a buyer who has otherwise paid through his noses and sometimes through borrowings and loans also. I would take a view that business transaction also is covered, though my friend has a different view, but I would take a view. It does not make a distinction between a person who is selling a property as a builder developer or otherwise. In fact, all cases of transfer are exposed if they are of land and building. So if you purchasing from builder, yes, you should deduct tax at source if it is leviable, but deduct it at a time when it is deductible. Even when the builder happens to be a case whose accounts were not audited in a previous year, even in that case, the taxability, the liability to deduct tax is surely there and you need to. The procedure is now notified, and this is just listing the procedure, the relevant rules, the relevant forms. Please look into that. The same question, now few issues which arise, and there are plenty. If we have discussed this today, I would believe that yes, that we would have served the purpose of today's meeting. So let's discuss them. Whether it's prospective or not prospective. Admittedly it is prospective, but again it could have a retroactive application. It could have a retroactive application. The cutoff date is a serious difficulty, and so because of the cutoff date, the point of taxation, when is it happening? Is it at the time of booking, payment, allotment, agreement, possession, conveyance? These are several stages which usually happen in all transactions with the builder developer. So which is the point of taxation? Ideally, the payment is the most relevant date. The moment I do this payment part, I am comfortable. Difficulty is that none of these stages also may be relevant, is that when I tell you that that the time of deduction is the payment or the crediting part of it. In case of a buyer like me, who is not in a business of buying assets, I don't credit a transaction. I make the payments, and as and when the agreement happens, when I have made full payment, I debit the transaction by creating an asset in my books of account. So therefore, in cases of an ordinary buyer, the question of credit usually does not arise. The question of credit usually does not arise. He doesn't credit anybody in his books of account. He simply makes the payment, and therefore, because somewhere we have to conclude, we can't keep on fighting with the government. We can't keep on inventing issues. We have to reconcile them somewhere. As long as it really doesn't have any teeth to bite us. Okay, if somebody is getting credit, I am least interested in getting into any serious litigation, because litigation today is a costly affair. So therefore, if I have to deduct tax and the payee also doesn't mind it, I might as well deduct it. What I am debating and discussing it with you is how to practically implement this transaction. So therefore, payment is the first red signal which will tell you that should you deduct tax or not. If you have already paid money and that is before the cut-off date, forget that is beyond the scope of deduction. That is something which cannot be exposed to deduction, because an event has already happened. An event has happened, it cannot be turned into a taxable event by virtue of an amendment which also is introduced prospectively. I think I am sharing my thoughts consciously and clearly with you, so that if you have some other thoughts, you will have to apply your mind. So therefore, the payment should be the first point of alert as far as you are concerned. Land and or building, the same issues which we have there, they will continue to be bothering you here also. Transfer is again not defined, and therefore yet again there is a difficulty, but a difficulty with a lesser effect, in as much as here is a case wherein if the payment is being made, should you really look into the fact that a transfer has taken place or not? Now there are two ways here and both could be legal and valid also One is, first of all, you need to establish that there is a transfer, and thereafter you need to see that there is a payment or a credit. Unless a transfer happens, there is no liability whatsoever to deduct tax at source, because it gets its power on transfer. It gets its power on transfer, but deduction is deferred to date of payment or credit, whichever is earlier. So unless a transfer happens, there is no problem here, no point of taxation at all. The other view is that if you are envisaging a transfer to take place, start deducting tax. Now this is, though practical, a dangerous view. In most of the cases of a builder-developer transactions, most of the transactions are reversed. The investors are replaced with actual buyers. And in all such cases, if the investor starts deducting at the earliest point of time on taxation, and if no transfer ever takes place, there is a difficulty here. Because under 199, I am afraid that there would also be a difficulty, because the income pertaining to those transactions are never recognized at all. They are never considered. They are cancelled, neutralized transactions. They have no income effect at all. The income happens when you resell it to the actual purchaser. These are food for thoughts. Don't bother your mind so much, but these are genuine legal issues, which you need to apply your mind to. There could be mode of transfers which are different. Exchange could be there, relinquishment could be there. And when I invite your attentions to 45.2, 45.3, 45.4, 45.5, they all are transfers. You can't laugh them off in the reasons that they also are transfers, and they also would involve land and building, and therefore there would be. So if somebody tells you, Bharat, that at the time of introduction in the partnership, you need to deduct tax, it's very funny, isn't it? Right? No, it's very funny. But what you are introducing is a capital asset, which is a land and building. And the scope of 194 IA is not restricted to capital asset. It exposes all kinds of asset as long as it is land or building. That's what it is. So even part transfers, there could be difficulties. A land in piecemeal, if it is transferred, a part of the building is transferred, it would be exposed to this. But this is something which you should take home and discuss it in detail, because it's difficult to find answer. Maybe Corey here as some answer here, is that there are huge transactions which chairman rightly pointed out. And like all these puzzles, I also have a puzzle that my chairman is married or not, See, he looks so young, every day I see him in tribunal, he is so fresh and young and very energetic. So I will have to find out that whether he is married or not. So coming back to this is, so indeterminate consideration, he told you that all of us are so obsessed with securing several efficiencies that tax in the process is sacrificed at the altar. So in such cases, the issue would be that there are several transactions. The larger transactions are transactions in which you cannot determine consideration. Very difficult. Take for instance joint venture. Take for instance co-development. Take for instance redevelopment, wherein the consideration is to be paid in the form of the constructed property at a future date. Sometimes it takes place, sometimes it does not take place also. Consideration many a times is linked to the future sale consideration. What do I deduct? How do I determine my consideration? This is not a stamp duty valuation. For stamp duty valuation, it's easier. These instruments at times presently are exposed to stamp duty, and I don't mind getting them stamped also. I pay duty on it. But this is not something, which is going to help me here. It might help me for 43 CA, but not for determining the amount on which I have to deduct tax at source. All major transactions are like this. Then you get into time sharing arrangements. Even in such cases, whether are you acquiring any land or building? If it is time sharing, are you acquiring it also for a part of the year? Then should you deduct tax at source or not? Is also something which you should think about. Exchange and relinquishment are going to be serious difficulties. Somebody is relinquishing his right in my favor. How do I know, and on what do I deduct tax? He is kind enough to relinquish rights in my favor, and I want to deduct tax on him. How do I do it? I do not know. I do not know how do I do it. But the law perhaps would require introduction, distribution, dissolution. It would also require the creditors' payments also to be covered. Usual things is that that post-dated checks are being asked. I am hurrying up a little. Is that post-dated checks are? Is it a payment? Is it a payment? Or it is not a payment? If it is a payment at that point of a time, even though the checks will be deposited 1 year down the line, you will have to deduct tax today. If you take a stand that post-dated checks, when it is being given, it's not a payment, perhaps you could defer the point of taxation. Debatable. Then resale by purchaser. This 715 is telling you that when there is a resale by the purchaser, even in such cases, the tax would be attracted. When seller is not liable to taxation, 699 says that in such case don't bother about taxation. Now there could be genuine cases wherein NGOs are developing properties. They have huge properties. Some of them would get into development as a part of charitable activity. Now in such cases, should I deduct tax or not? Because 699 says is you are spared of taxation. The last one is more important, is 194 IA operates in the field of 17B. If you fail to deduct tax, what do? What are the defaults you are committing, and what is the penalty you would face? A, you would be considered as a person who is deemed to be in default. B, the tax which you should have deducted but have not deducted, it will be recovered from you. C, it would be liable to interest, and D, it would be liable to penalty also, 2011A. This is the way it would go about. Now 201 has been amended, so is 206C also, which says that wherein cases where tax is not deducted, and if by way of a proviso it has been provided that if the payee later on gives you a certificate and the CA certificate and showing that his income is included, then in such case the tax will not be recovered from you. then in such case the tax will not be recovered from you. The same position will apply and prevail in case of 194IA as well. If that is so, even if you have not deducted, but if the builder has paid tax from you, tax on his income, there would not be any difficulty. But for the intervening period, you might be required to pay the interest for the default. This has no difficulty as is happens in the context of 40A1A. For non-deduction, if you are slapped with 40A1A, there is a serious problem. But in this case, when you are purchasing something, which you are not claiming it as a deduction, unless you happen to be a builder developer. Otherwise, there is nothing, which you need to fear of. So this is something which is kind of a relief which has to be explored if you need to. Then, payment which is based on stages of completion, which does not as and when the slabs happen, if the slabs are put on, the liability to pay, the amount would arise, a part of the consideration would arise, but there is no transfer at this point of time. So unless you take a stand that that transfer need not happen, but tax payment attracts the liability, even this would not be liable. In many cases, advances are made before purchases. Even in these cases, there would be a difficulty. At the time when you have given advance, it is advance. The property is undefined, the area is undefined, the rate is also undefined. In all such cases, one will have to find out a mechanism whereunder you can deduct tax at source. Payments are made by third party. Usually, buyers borrow from financial institutions, banks. Now the payer, therefore, banks prefer, FIs prefer to pay directly to the builder. So who has to deduct this tax at source and who has to upload the returns is also a practical issue for which I presently do not have any answer. Then do I have to take the gross price or the net prices? I am also being allotted a parking space. Is it acquisition of a land or a building? Surely not. Not even a right in a land or a building. Then in that case, should I expose these also to taxation, to deduction or not? I do not know. In many cases, I am allotted shares. There is no agreement. There is no transfer of land or building at all. The company form of organizations owns the land or building. By virtue of my shareholding, I just enjoy the occupation of the premises. I would advise you to deduct tax at source if it is not hurting you. But there could be a genuine difficulty. Should I include VAT and service tax and thereafter deduct tax at source? You have conflicting circulars. Both of them I have cited. The first one says in the context of 194I, I would not. The other one says that I should exclude VAT and service tax. So you will have to take your own call. Reimbursements, 715 wrongly states that even reimbursements are to be included. If this is to be included, all those payments which I would be making towards the water charges, water tax, municipality taxes, maintenance and all would also be exposed for the purposes of deduction of tax at source, which I would believe is not the intention. Additional consideration for delayed payment of consideration. You pay interest. Sometimes the interest is settled and therefore take the character of compensation or damages. Sometimes it becomes part of consideration. Sometimes you provide amenities also, which is surely not for transfer of land and building. And sometimes amenities running into crores of rupees are provided. So therefore, the issue here would be, should I expose it to deduction of tax at source or not? Is yet again an issue. Co-purchasers and sellers, the courts have been telling you that in the context of 194I, even though there are co-owners, you need to treat them as one owner. But there is a beneficial circular which says that you will have to define limit with reference to each co-owner, and therefore here also I will take a view that if there are two buyers and the premises are worth less than 1 crore of rupees, then in that case no deduction of tax would be required. But this is the conflicting view, which is a non-judicial view but a beneficial view. buyback of premises. Today, many of the builders, just for the sake of it, also get into buyback of premises because it's fashionable. Now, in such cases, therefore, the issue would be that on buyback, would the builder now deduct tax at source or not? Because he is now paying you the money. Okay, and the deposits which are refundable or not, that also, one has to see this. With that, I should be permitted to sit down for the reason that it is already past 8. We had met mainly for discussing this. 35 AD venture capital is all that is listed here is wrong. Actually, as far as 1023 FB is concerned, it's repetition of 35 AD. So kindly look into that. Then infrastructure debt fund, then SEZ, World Heritage Site, hotels, then real estate investment trust. It's a very fascinating subject. Year of taxation of developer. This is a Supreme Court decision. Relevance of project completion method of taxation. I have charted the entire history here. Kindly look into it. And the conclusion would be that in respect of projects which have commenced on or after 1/4/2003, project completion method